Okay, welcome to the August 23rd edition of the Fats, Fuels, and Oils webinar. Today we've got a special guest. David Becker is going to talk a bit about, I think, using options to gauge sentiment. I can't exactly remember. We planned this out a while ago, so I can't remember, but he's going to talk about something that I think will be useful to everybody. And we're going to talk a little bit about vegetable oil markets and what's been going on, and then go through our usual kind of review of what's going on in the biofuel industry, and then we'll turn it over to David. Okay, so let's get started. So soybean prices really broke out of the recent trading range yesterday, and the driver behind that has been strength in soybean meal prices. And I think we talked a little while ago about sort of the lack of or I guess maybe a better way to put it is a speculative short oil share position, and how I was kind of surprised by the fact that despite the fact that we've got this big growth in renewable diesel production that everybody's expecting to increase the demand for feedstocks, that the funds were loading up on soybean meal instead of soybean oil. And it turns out that that those concerns may have been, or those positions may have been well-founded, because on Monday, the thing that drove the market higher was concerns about crushing volumes in Europe and South America. People are concerned about crushing volumes in Europe because of the energy costs, and people are concerned about South America because of the drought, and because Argentinian farmers tend to hedge against inflation with soybeans, and so their sales of soybeans out of the latest harvest haven't been keeping pace with prior years. And so right now the market is very focused on soybean meal, and this happened one time in 2014 or 2015. It was a little different. Obviously, the dynamics of the vegetable oil market weren't the same, but there was a delay in the U.S. harvest, and there was a relatively large export program that had already been sold. And so the delay in the harvest caused soybean meal prices to sort of rocket higher for about a month, or maybe a little bit more than that. And I think that this is probably, I think we're probably in a relatively similar situation, with the one caveat being that obviously the setup for the oil market is different. So I think that soybean meal prices are probably going to be in charge here over the next 6 weeks or so, and that could take soybean and soybean oil prices higher as soybean meal prices rise. Now, you can already see the impact of the Argentinian short crop and slow farmer sales on crush volumes in Argentina. The Ministry of Agriculture released their crushing volumes for July, and Argentinian crush was just under 3.5 million tons, which was down about 350,000 tons from last year. And so far, through the first 4 months of the Argentinian marketing year, crush has fallen below last year's level in each of those months. And during the first quarter of the marketing year was down about 5% from the same period last year. So we cut our forecast for Argentinian crush by 1.5 million tons this week. And that means that soybean meal exports, we reduced our forecast for soybean meal exports by 1.9 million tons, and our forecast for soybean oil exports by 750,000 tons. So that shortfall, while it's not huge, it's time sensitive, and that's why I say I think that over the next 4 to 6 weeks, until we really get into the U.S. harvest, over the next 4 to 6 weeks, soybean meal prices are probably going to be in charge of the oilseed complex. And when, or at least the last time that this happened, again, soybean meal prices shot up, and it was something that I literally got daily questions about for like 4 to 6 weeks. And it took a while to kind of figure it out that time, because it wasn't as obvious as it is this time. That time it was more focused on just the delay in the US crush. Whereas this time, again, it's focused on Europe, South America, and also China. Somebody that I talked to yesterday said that they were concerned about the Chinese crush, and a slowdown in the Chinese crush then driving more meal imports. And Chinese crush margins have been negative for imported beans, and so you would expect a little bit of a crush slowdown anyway. But I think this week I took down my Chinese crush by a couple million tons, and so all of this just sort of, again, continues to argue that in the short term, meal is going to be driving the bus, so to speak. However, in the longer term, I think that the impact on veg oil supplies worldwide is probably going to be the lingering effect of a slowdown in crush in South America and Europe. And while, again, the decline in our forecast for Argentinian soybean oil exports isn't that great, and you also have the potential for Canadian canola oil and Malaysian palm oil to step in and offset whatever shortfall there is in crushing volumes, it's still, given again the fact that we expect that soybean oil demand is going to grow with the increase in renewable diesel capacity, and the world was kind of just getting back into balance, or at least it felt like it was starting to get back into balance. This is something that could potentially change the outlook for our outlook for vegetable oil prices and more broadly for feedstock prices. Now let me share my screen. Now I haven't changed my my forecast yet, in part because the U.S. crop is still, I think, in good shape. If you look at the weather forecast today for Iowa, which is kind of where I'm focused, because that's been it's one of the largest soybean producing states, and it's also been the area that's been drier than a lot of the rest of the country. But if you look at the forecast for Iowa, we just got some rain last week. There's more rain forecast for the end of this week or early next week. And so, like I kind of said before, if you stress a soybean plant and then you give it timely rainfall throughout the pod filling period, that's a good way to make a good crop. And so I raised my U.S. average yield forecast. I think I told you last week. If I didn't, anyway, I raised it last week to 52.5 bushels. Which is about 0.6 bushels an acre above USDA's August forecast. And as long as the trend in weather kind of continues, where it's not that hot and you get timely rainfall in the Western Corn Belt, I think that it's more likely that I raise my yield forecast than I lower my yield forecast. And so if that happens and La Nina goes away, I still think that there is a chance that this drive higher from meal prices can lift soybean prices in the soybean complex and oilseed complex more broadly, can lift prices in the short term. But then once you start to harvest the U.S. crop and the U.S. crush kicks in and the South American production starts and La Nina starts to fade away, then I think it's going to be awfully tough to maintain soybean prices above sort of 14, and still think that the first stop on the way down is 13, and potentially you could get down to get down to as low as 11 in the sort of the extreme case where the South American crop is just a blowout and US yields are 53 or 54, but probably more likely somewhere between 12 and 13, which would imply soybean oil prices, given all of the usual caveats about oil prices and everything else, that would imply soybean oil prices a little below 60 cents, probably I would call fair value at that point, maybe 57 cents. Again, if oil is going to go back up to $110, it would look a little bit differently, and soybean oil fair value would probably be 60 cents or a little bit above 60 cents. If oil is going to go down to $80, it would probably shade closer to 55 cents. But again, depending on how this crush plays out, and if we have to continue to cut our crush forecast, particularly in Argentina, then there's some upside risk to the price forecast from that outlook that I just gave. The other thing that I did to Argentina is because of the small crop, and I didn't do this week, but I had done this prior to this week. Because of the small crop, Argentinian soybean exports are expected to fall sort of year over year, and so we get back to that discussion about whether the ABCDs will favor crushing soybeans or exporting soybeans. And again, I think given where crush margins are, the nearby board margin is like above 225 a bushel, and the average for 22-23 right now is just under 175 a bushel. I think they'll continue to favor crush, but if I have to raise my Argentinian soybean export forecast, then I'll have to take the crush forecast down, and then that just becomes a bigger hole for either U.S. exports or more likely palm oil, less likely than palm oil, but more likely than the U.S. exports, is Canadian canola oil will need to sort of fill that gap that's left by first South American crush, particularly Argentina, and then by European crush. All of this means that that the basis at the Gulf, which has risen to 7 cents, it kind of doubled in the middle of July, is likely to remain at 7 cents, or maybe even go up a little bit from here, again, at least in the short term, until we get to the U.S. crush. And then where it goes after that will depend a lot on what's coming out of Argentina, what's going on in Malaysia, and how big the U.S. and Canadian canola crop end up being. In Malaysia this week, I raised my palm oil production forecast by 350,000 tons, and increased my palm oil export forecast by 250,000 tons. So, or by 200,000 tons. So that raised our ending stocks forecast just above the 2 million ton level. Now, in the weekly commentary, I talk a lot about the potential, why that increase above 2 million tons doesn't mean what it typically means this time, because usually you would think of an increase above 2 million tons is weighing on palm oil prices. And although, as you can see by the forecast, we do expect palm oil prices to fall, there are some reasons to think that outlook might be a little bit too pessimistic. The first is the spread between palm oil and soybean oil, which in the nearby contract continued to widen and now is just around 27 cents. That could and would likely narrow if palm oil exports are needed to fill a gap for soybean oil exports from Argentina or the US. But it also could narrow, but also if you have a big increase in palm oil exports, you also wouldn't expect that that the price would come under as much pressure, I think, as maybe we're projecting. So despite the fact that we raised our forecast above 2 million tons, and I guess the other point to make is if palm oil exports are going to be stronger than we expect, then probably stocks aren't going to be above 2 million tons anyway. So I say all that to say that despite the fact that we have this outlook that kind of suggests that prices could come down, and it started to feel like I said, like the world was getting back into balance in vegetable oil. It may be that this this situation in global crush volumes may mean that you see an increase in our price forecast in the coming weeks, and it will depend on you know, how big the U.S. crop is, what early crush looks like after the harvest, U.S. crush looks like after the harvest, where Argentinian crush and all of that goes. But I think that Monday's move, which has been followed up by another big move up in soybean prices today, I think that is sort of the alarm bell going off and suggesting that that we may not be finished with at least the possibility of soybean oil prices rising back up to test the highs. Again, I don't think that's the base case, but I think this sort of sets up the potential upside risk that could make that happen. All right, with that, let me go through biofuels really quickly. So we got data from the EPA's moderated transaction system for July, and as you can see by the chart, July production came in below where we expected and well below sort of the 5-year average, at least for biodiesel. But renewable diesel production also fell for the second consecutive month in July, at least domestic production did. And imports were also relatively weak for both biodiesel and for renewable diesel. It's a little bit surprising given what we saw the HOBO spread do in July, but I guess as I was thinking about it, July production is probably set a month or so before July, and so I think when we get data for August in about a month, that will give us a much clearer indication of that impact on the impact of the decline in soybean oil prices on production and sort of more broadly in feedstock prices on production. Again, if production in August remains relatively depressed relative to what we think it should be, I think that probably means that I think that's another data point that might suggest that in terms of sort of excess fat and grease supply, that we are closer to using up all of the fats and greases than we might think. And so if production rises a bunch, then that's what sort of the HOBO spread suggested, and not that the HOBO spread, as you can see, is the world's best indicator, but it's an indicator of profitability. And we know that margins were strong in July. But if that continues, then I think it's more of a feedstock supply issue rather than a margin issue, because again, margins are good. Okay, so looking at our estimate of gross margins, the first thing that you'll notice is that our estimate for biodiesel margins is significantly higher than it has been, and that's because I finally got around to including the value of glycerin in our calculation for gross margins for biodiesel. And so that revenue was added through the whole series, and so it's not like this week is the first week that we've added it and that you can't compare the rest of the series to this week. We changed the whole series, but we added it. and we added our projection going forward. Now, we don't have a ton of visibility on the glycerin market, and so our price forecast generally is whatever last week's price was for the future. Now that we're including glycerin in our margins forecast, I will start to work on building a better model than last week's price for glycerin prices. It's going to be difficult because there isn't a lot of information out there about glycerin production or demand, but I think we can probably start to put something together again that's at least better than last week's price. Okay, all that said, margins went up for both renewable diesel and biodiesel last week, and we expect that renewable diesel margins probably remain in this range, in the range that they're in now through the end of the year, while for biodiesel, we expect that that margins will decline a bit from the current levels. But I think that this chart always drives me crazy. I think that this looks right, but the forecast I think is that biodiesel margins rise up to about $1 a gallon through the end of the year, rise slowly, and then sort of by the end of the year kind of reach $1 a gallon again. And that is due in part to our outlook for soybean oil prices. So obviously, if soybean oil prices are going to end up being higher than we forecast, then our biodiesel margin estimate and forecast would be lower. Renewable diesel, I think that for fats and greases, most of them remain at or close to their record highs. Most of them are just a shade below their record highs, and so the margin forecast going forward is really a function of our outlook for fuel prices, and we have fuel prices slowly declining. But again, yesterday we heard from OPEC, and they said that they may cut oil production. That's fired the oil market back up, and so oil's up 3% today. It was up pretty sharply from just before the announcement yesterday to yesterday's close. I think it was up a buck or so, or maybe a little bit more than that from just before the announcement yesterday to yesterday's close. So it seems like the oil market is taking OPEC Plus pretty seriously, and we may need to revise our fuel forecast. But at least for the moment, we've got a relatively slow decline built into to prices. All right, for RIN prices, don't think there was a ton of change this week. We adjusted from the models a little bit because the models wanted to predict prices that were a little bit higher than the current market suggests. And so I think week over week, there probably isn't much of a change, but we just shaded production, or we just shaded prices down a little bit from what the model would suggest. And then for LCFS credit prices, no change to the forecast here. LCFS credit prices last week, they kind of remain around this $90 level. Now last week I said it looked like they had kind of bottomed and started to go up, and then of course they started to come back down a little bit. But it does seem like they're stabilizing around this $90 level. It may be that prices will start to rise as we get closer to the end of the year, and the potential changes to the CARB program, and maybe we just kind of hang out at this 90 level for the next several weeks or next couple of months, and then start to move higher. All right, with that, I will turn it over to David and let him talk, and I will go on mute. And then when David's finished, you have any questions for David, he'll be happy to answer them. And I see there's already another couple questions. I'll answer those once David is finished. All right, with that, I'll shut up.
Thanks, Tori. So Tori and I talked about a month ago, and we discussed potentially putting together a presentation on using volatility as a sentiment index. And unfortunately, I didn't get the volatility data that I needed until today. And so what I will do is do a presentation on hedging, why to hedge, and what you can use in the fat markets to hedge. One of the things that I'll start with is just two different histograms, if you can see this page. And the histograms show you the return profile of different products. And so here I have a histogram of the monthly returns from 2015 to 2022 of distillers corn oil, and next to it is a histogram of used cooking oil from 2017 to 2022. And so what a histogram shows you is the return profile. So if you look at distillers corn oil, you can see that the majority of the monthly returns, where what you should expect month over month for those 7.5 year, 7 3/4 year periods, is anywhere between -5 to 1%. And that's where most of them come in. But you can see that there are tails to that, where some of the returns are -11 to -17%, and some of the tails are between 12 and 18%, and those are rather large. And so if your business profile when it comes to the feedstocks that you're using in refining is to make sure that these are stable, so you don't have to speculate on the direction of distillers corn oil, you might want to consider hedging. The standard deviation of those returns is 7.25%, which means that about 68% of the time, you should expect that there are monthly returns based on the data that you get from the Jacobson Fast Markets would be about 7.25%. And those are relatively large over that period of time. It's even larger if you look at distillers corn oil from 2021 to the present. It's something like 12%. Used cooking oil also, you can see most of the returns are right in the middle between -1.1% and +1.8%. But again, there are tails to them where the downside is between 4 and 6.9% and 7% and 10% for the upper tail. Again, what that's showing you is that the monthly returns, if you are looking to have a smooth feedstock where you can have a constant price put into your refining capacity or whatever you use your used cooking oil for, that it jumps around quite a bit. And by jumping around quite a bit, it can make the returns that you have from your refining pretty difficult to deal with. Right. I also put together a sort of a page that shows you the distillers corn oil and used cooking oil based on the Jacobson data that is historical volatility along with price. And so you can see, as you know, prices have risen considerably since the end of 2020, and so has historical volatility. So what is historical volatility? I'm sure you guys have heard the term before. What it is you're taking the standard deviation, what I showed you on the page before, standard deviation, and you multiply it by the square root of time. So it's as simple as that. You're getting an annualized number that tells you how much that should move per day and per year. And so what you can see is that in both charts, of both distillers corn oil and used cooking oil, the historical volatility is relatively elevated. And you can see the historical volatility is on the chart of the y-axis to the left. I made these things so they're comparable. It's really something similar. And so what can you do about it? All right, so there are some people who definitely have used hedging tools like soybean oil or CME soybean oil to hedge their distillers corn oil, tallow, use cooking oil, chicken fat. And historically, those have been uncorrelated, meaning the movements of those two products together are not in tandem with one another. And so an alternative is to use over-the-counter transactions. And there are two types of over-the-counter transactions that I'll talk about. One is called a swap, and the other group is called options. Over-the-counter means that you're doing a private transaction instead of doing a transaction on an exchange where you would post margin and face off against the clearinghouse of the exchange, like the Chicago Mercantile Exchange or the Intercontinental Exchange. You would do a private transaction with another counterpart who might ask you to post margin, but might ask you not to post margin at all. And you would just change cash flows when you needed to. So I'll start with a swap. And so a swap is a fixed for floating cash flow. It's like, think about it like a futures contract almost. In some way, you're swapping one instrument for another. So in theory, if you buy Apple stock, you have paid a fixed price for Apple at some particular point, and then it's going to float around with the market at different particular points in time, and then you might sell it for a gain, or you might sell it for a loss, but you paid a fixed price for it at one particular time. Swap is very similar. If you have feedstocks and you saw that they're not correlated to futures, you might consider purchasing an over-the-counter swap with a counterpart. And there are counterparts or clients of fast markets that have expressed that they have or are willing to make swap prices, especially on distillers corn oil, but other fats as well too. And what a swap does is it allows you to either fix, or if you want to sell, float your cash flows, but it's basically like buying and selling. Okay, and so this is exactly what the payout would look like of a swap. As I said, it's like buying and selling. If you purchased a swap at 70 cents per pound and the price went up to 80 cents per pound, you'd see a gain, and the gains would continue as the price continues to rise. And as the price falls, you would lose money and you would continue to lose. And there are realized gains when the swap actually closes out, and there are unrealized gains during the course of holding the swap transaction. And so this is what that payout function would look like. And so what I sort of made is a chart of what would happen if you had a physical contract, which some clients of Fast Markets has, and combine them with a financial transaction. And the upshot is there are some clients that use the data, the Jacobson Fast Markets data, to create their physical purchases. So for example, you might say on September 1st, we're going to purchase XYZ number of pounds of distillers corn oil or used cooking oil or chicken fat based on the average price of the Jacobson data for that particular product over the past month, say August. And so September 1st, we'll buy the average of what August is. Now, what you don't have when you do that is the ability to say exactly what the price is going to be. You have no idea what the price is going to be during the course of the month. You only know what the price is going to be at the end of the month. And so there are physical contracts that we know of with clients of Fast Markets that do that, and they do it in agriculture and in feedstocks, as well as metals and mining, as well as different forestry products. And so that is a typical way that different clients purchase their physical products. Well, if you actually combine that with a financial product like a swap, the standard deviation of your returns would look like this chart over here. It would be completely flat. You're basically taking all of the exposure out of the market. So For example, if you just decided to pay, 70 cents in 2022, you could see that there would be times when the price would be, you would lose money if it was 65 cents, but then you would make money if it was 74 and make money if it was 80 and make money if it's 79. So your fixed price, the price that you would pay would be one particular price, and all of the movements, like for Distillers Corn Oil that has a standard deviation of 7% a month, you basically say, I don't want that standard deviation. I don't want any movement at all. I want to fix my price. And since I have a physical purchase that I base against this particular data, I'm going to look for a financial purchase that I can fix against that data. And that will make it so the changes in the feedstock returns that I have will no longer be variable. They will be fixed. And that's a common way that this is done in many other types of products. People do it who actually have soybean oil will buy fixed price swaps on CME soybean oil, using that as a mechanism. If that was correlated to your product, then that's perfect. But if it's not, then you have that issue where you need to go out to a market maker who might do that on Distillers Corn Oil. Okay, an alternative is an option. So an option is the right, but not the obligation to purchase an underlying at a specific price on or before a specific date. And so there are market makers who will make markets on an option. And there are some benefits of an option relative to buying a swap. On a swap, you are fixing your price. And so if you are a feedstock buyer and you say, I'm going to fix it at 70 cents per pound and it drops to 60 cents a pound, you're going to lose 10 cents on your fixed price financial obligation, and you're going to gain 10 cents on your physical, but there's no benefit at all. You've fixed your prices. The alternative is to use an option where you're paying a premium up front for the right to fix your price. So instead of saying, I'm going to fix my price, I want to buy the right to fix my price. So it has some of the same aspects, but instead of definitely doing it, you're saying, I want to have the right to go about doing it. And for that right to go about doing it, you're going to pay a premium upfront to a market maker who'll be able to do that. Alternatively, there are ways to sell options. For the most part, I'm going to talk about buying options in this particular example. And we have there's a market maker that we've dealt with, who we've introduced some of our clients to, who do vertical spreads, which is buying a call spread, which is a lower strike call and a higher strike call, or a put spread, which is buying a put and a lower price put. And that allows you to pay a premium and lock in your fixed price. And so this is what sort of a payout would be if you were lucky enough somewhere in the end of 2021 to say, I'm going to buy a UCO call spread that is a 60 cent versus 70 cent call spread. What you can see is that you have to pay a premium up front. And then starting at the low point strike, 60 cents, you start to make money and you break even at your premium price, and then you continue to make money until you cap out into the higher strike call. So sort of like an insurance policy, you're basically saying, I'm going to pay insurance to capture particular gains for a specific price range. Almost like if you were going to buy hurricane insurance and say, I have a house that's worth $1 million and I'm that's on the beach, and I'm going to pay a certain amount of premium that's going to protect me up to $900,000. It's going to protect me between $200,000 and $900,000, and then it's going to cap out after that. That's what a call spread basically looks like. And so what I did was put together an example. If you did that in like sort of the end of 2021, if you were lucky enough to think, prices are 54 cents, I think they're going to rise. I'm going to buy a 60 and 70 cent call spread, and I'm going to pay 2.5 cents as a premium. You can see that if in November with the settlement price of 57.20, you are actual level that you would receive would be that 57.20 plus 2.5 cent premium. And it would be the same thing for December, but by the time you got to January, you would have started to cap the exposure that you have. So the most that you would wind up paying at is that bottom strike, which is 60 cents plus 2.5 cents to get to your 62.5 cent premium. And as the prices rise, you would continue to be protected until it got above 70 cents. Then all of a sudden you are capped at 70 cents. You wouldn't get any additional protection above that. You would gain between 60 and 70, and you would cap at 63 cents. Now, what this tells you and what you can see from the returns that occurred over these months from November through July is that the standard deviation of the returns is on used cooking oil is 1.91. If we went back to the very first page, you could see that the normal is 3.5%. So by doing something like that, you would limit the standard deviation of your returns. It wouldn't fix them like a fixed price swap. You wouldn't have something that's completely eliminating it. But at the same time, if the price, and it didn't in this situation, tumbled, the most you would ever lose is the 2.5 cent premium that you paid up in this example. So if in the by January, if the price was at 40 cents, well, the most you would lose there is 2.5 cents the premium you paid, as opposed to potentially losing if you fix this at 60 cents, 20 cents per pound. And so this is just a picture of what a call spread would also look like if you did it going forward. A 75-80 call spread is the same type of thing. You're paying out a particular premium and then it caps off at a particular level. All right, so one of the things that I do is help people understand this, go through it. This is sort of a bullet point of the different things that go on with our risk solutions group. One of the two most important things are the actual modeling of your portfolio and determining the risks that you have, as well as helping you determine the risks of your hedge, the actual hedge, and then what happens during the course of the hedge and when the hedge rolls off. And the last chart I put together is just what sort of a value or risk model is. And this is kind of an interesting concept. I talked about it at the Biofuels conference. It's fairly routine at a trading desk level, especially in the financial world. Almost every single financial desk has a value at risk for their desk. It's a way for the upper management at any financial institution or a hedge fund, pension fund, mutual fund, to be able to look at a particular desk and say, this is exactly the exposure we have if we have an X type of standard deviation move. And given that we have that X type of standard deviation move, what kind of money could be lost in that scenario? And desks in general, trading desks in general, hedge funds in general, or individual portfolio managers have a limit on what their value at risk could be. And so what is very interesting to do is to calculate the value at risk that you might have based on the historical data that is embedded into the fast markets Jacobson data that you use. And so we can use that data to determine the risk that you have to your exposure based on any of the contracts that you might have outstanding, or how you look at the prices that we have that we can be able to, that you use. And there are multiple ways to do that. You can look at the historical data, and then you can do some other stuff which are called simulations. There are cupola simulations and Monte Carlo simulations, which are basically taking the data itself and looking at the correlations and the historical volatility of those data, and then looking at what in the future could be a scenario that could happen. Generally, they are very well tied to the historical data themselves. And so one of the benefits of having the data at Japes and Fast Markets is that we can run that value at risk for you. And so it basically, some different things that people use are, what kind of outlier do you want to see? Like if we have a 99%, move, like a 3 standard deviation move, or 95% scenario where there's a 2 standard deviation move, and then figuring out the type of loss that you have, and then using different hedges to determine what kind of loss you might have if you mitigated your risk using the hedge. That's about it for me. I appreciate Tori giving me the opportunity to go through this. And as I said, now that I have the historical volatility, implied volatility data, if he lets me, I'll come back within a month or two and provide you some information on how I can go about doing that. And I'll just I'm going to mute myself now if I can quickly figure it out.
All right, with that, let's go into some questions. All right, here's a question for David. I'd expect that there'd be a bit of regime switching for feedstocks due to the nature of increasing feedstock use for biofuels. Curious if you have considered potential non-stationarity of the historical data sets.
I actually don't know what you mean by non-stationarity.
So non-stationarity means that if you have a big data set and you have a mean, right, for that data set, if you go in and pluck out a sample from that data set, is the mean going to be within the range of whatever that mean is, within some standard deviation of whatever that mean is, or does sort of the mean of that data set kind of move around a bit, basically?
Yeah, I mean, I think that's within every time series that you take a look at, that you always have to sort of like back test, if you're going to do it in a trading scenario where you are back testing multiple types of little parts of the data to determine where the real mean is. And that's always a moving mean. So could it always be a moving mean? The answer is yes, it's always a moving mean. And there's always a change in the regime, at least in my opinion, the way I look at data.
Well, and I think, I think the way that I think about sort of this question is that, given the fact that we're probably going to get to a point where essentially we've run out of fats and greases, right? There's no more excess supply. You would expect the volatility in prices to rise in the same way that if you look at sort of the natural gas market in Europe right now, you see not only high prices, but you see a lot of volatility too, where prices are moving up a lot, but then some days they move down a lot too. And so the impact of that kind of change on the options programs that you're talking about, or the swaps programs that you're talking about.
Yeah, so on the impact on the swaps programs are probably negligible. The market makers are either going to decide they're going to make a market for you or not make a market for you. The different companies that are making swaps are banks at the moment, or one of the ABCs. And so what they've decided is they actually have physical markets behind their actual financials. And so they're willing to take the credit risk of a counterpart to be able to make a swap transaction. And for the most part, what they're doing when they do a swap transaction is they're figuring out a way to sort of back-to-back their financial deal with a physical deal that they have. And that's why they're willing to go and do that. In the options market, it's completely different. There is one market maker that we work with, Stable, that makes markets in these particular feedstocks. They look at things just like I would look at them, where they're looking at the historical volatility and then using some type of model like Garch to determine the implied volatility that they're going to use for the future. And as volatility rises, like it has done, they're not going to go back to a historical mean. They're going to use the current high implied volatility to make their option prices. Similar to the way you look at natural gas, nobody is going to look at natural gas in Europe at the moment and say, well, in the future, things are going to calm down. They're going to use high levels of implied volatility to make it so to the extent that they will not get run over if the market continues to blow up the way it is. And I think also people's view continues to make that more volatile. So you have higher implied volatility levels. You're going to have higher historical volatility levels in both directions, both up and down.
I think just generally from options trading, I think it's easy to think about this stuff and think like, oh, well, if volatility is going to be higher in the future, that's also going to lift my option values, right? So if I can buy an option just before volatility sort of explodes, that my option will be worth more just generally, whether the price goes up or down. Obviously, if it goes against me, it's going to be worth less than it would have been otherwise anyway. My point here is that if you can do that before the move in volatility, then that there's some potential for either bigger gains or smaller losses. Once you're in sort of the higher volatility regime, then as you said, they're not using the old historical volatility. They're going to use basically whatever the worst volatility, the highest volatility that they can justify to price the option, so that then it becomes very hard for that to work out in a positive way for you. And unless volatility continues to go up, more than likely it works out in a negative way for you. Is that fair to say?
It's very fair to say in a lot of these circumstances, especially the one with stable, they don't allow you to exit your trade. So you're staying in the trade for the balance of the trade. So whatever implied volatility level that they use to price their option is what you're going to have. And so, I gave an example of like 10-cent type of option with a 2.5 cent price on it. I would say if you're able to get anywhere between 3-to-1 and 4-to-1 on your under, the amount that you're paying for the payout that you have, you're doing reasonably well. And if you can look at it, if you look at different options on the futures exchanges as well as the stock exchanges, and for things that are reasonable, that are close to the money, those are reasonable levels to actually look at.
Okay, thank you. All right, for the chart on HOBO spread versus excess biodiesel supply, are you adjusting for RBD spreads in any way? So that chart is based on the futures market average, I believe. And I say that with a question mark at the end because there's a couple of ways that there's like 7 or 8 of those charts in there. And I think all of them, but maybe one are based on futures prices and not on RBD prices. So I'm fairly sure that one does not adjust for RBD spreads. And then are the gross margins calculated using RBD soybean prices? So yes, the gross margins are calculated using the gross margin for biodiesel, which is we assume 75% soybean oil, 25% yellow grease. That soybean oil price is the Central Illinois soybean oil price adjusted for logistics and adjusted to the RBD price for the California market. And then when you refer to projected fair values for soybean oil, are you referring to futures price or cash price? So yeah, that's a very good question. So when I talk about that, or when I'm, at least at this point, when I was talking about it this week, I was thinking about that's the futures market, because that gives us all sort of a common number that we can look at. And then that have cash market transactions will have some basis to that futures market that will be relatively unique to your location, and then you can adjust based on what you think your average basis is from the futures market. And so that's why we generally talk about futures market when we're talking about fair value. All right, that is, oh wait, I think maybe one more question. Nope. That is it for this week. Thanks everybody for attending, and thanks so much to David for presenting. Like he said, we'll have him back in another month or so, and we'll talk about this concept of using options as a way to gauge the sentiment of the marketplace. When we talked about this before, it's something that I think is really interesting, and something that ultimately I think we probably, once we get to sort of the Fast Markets website, is probably something that we will start to include in some way on in our forecasting report. But again, I'll have him back in a little bit and we can talk about that again. So everybody have a great week, and I will see you all next Tuesday. Bye.